Hey guys, Florida Real Estate Sales Associate course, chapter 13. There's a lot of math in here, so I'm not going to be doing the math because I don't have a whiteboard, etc. The pointers, sorry, I forgot to say chapter 13 pointers. This is not the entire chapter 13. Here we go. FHA insured loans. The Federal Housing Administration, FHA, was created in 1934 to provide sound lending practices, promote home ownership, and upgrade housing standards. The FHA is part of the U.S. Department of Housing and Urban Development, otherwise known as HUD. The FHA does not make loans. Instead, it insures loans made by approved local lenders. The maximum loan amount. Effective January 1st, 2010, the maximum nationwide basic mortgage limit is $271,050 for single-family residences. Duplexes, 3-family and 4-family properties have mortgage limits of $347,000, $419,400, and $521,250, respectively. Single-family residences located in designated high-cost areas may qualify for loans up to $729,750. Higher limits are available for 2 to 4 family properties. These amounts are subject to change based on national average sales price. Prepayment privilege. FHA-insured mortgage loans must provide the borrower the right of prepayment without penalty. That means that they have to be able to repay. You have to be able to repay your loan without getting charged. Pay your loan earlier without getting charged. VA guaranteed loans. The VA mortgage loan program guarantees permanent long-term mortgage loans originated by VA-approved lenders for owner-occupied residences. That's the VA is only for owner-occupied residences, including condominiums and mobile homes which meet VA standards. If mortgage money is not available, the VA will loan money directly to a veteran. If default occurs and a loss results from foreclosure, the borrower is responsible for the loss. Eligibility. A veteran's eligibility for the mortgage loan program is shown on a certificate of eligibility obtained from the VA, which indicates the amount of guarantee the veteran is eligible for. Entitlement. A veteran must serve a minimum specified amount of time to be eligible and be honorably discharged. Conventional mortgage loans. PMI, Private Mortgage Insurance, was introduced by the Mortgage Guarantee Insurance Corporation. That's the MGIC, like magic without the A. Magic, magic, magic. In 1957 and is currently available from several competing firms. Federal lending regulators usually require this insurance when the loan amount exceeds 80% of the value of the property. Amortized loan, I'm just going to give you the basic, is the interest portion plus the principal portion equals the monthly mortgage payment. As the interest portion will decrease every month and the principal portion will increase every month. Payment minus monthly interest equals monthly principal. It's a PIP sandwich. You can look at it on either your document or there's a video directly from Gold Coast School of Real Estate online of how to do a PIP sandwich, how to amortize a loan. Graduated payment mortgage. During the period that the payments are insufficient to amortize the loan, the principal balance actually increases as a result of negative amortization, which means that if the monthly payment doesn't cover the interest and a little bit more to reduce the principal, then it ends up in negative amortization. So even though someone might be paying a monthly fee, they're still not reducing the actual amount that they owe, and they're even increasing their loan technically. Reverse annuity. I don't know how to pronounce that word. It's ANNUITY. I'm going to ask someone after. Reverse annuity mortgage. I'm just going to say that. The Florida Home Equity Conversion Act of 1988 was passed by the Florida legislature to assist homeowners 62 years of age or older. Construction mortgage loan. A construction mortgage loan is a short-term loan that provides funds for construction. The loan is paid out over a year or two in installment called draws, which funds construction at specific stages of development. That's actually very interesting. Even though this is not one of the pointers I'm going to share. By paying the construction mortgage loan out in draws, the lender is assured that certain specified construction has been completed prior to the payment of the next draw. Once construction is complete and the property is sold, the construction loan is replaced by permanent financing known as a takeout loan. Sort of like Chinese, but a loan. The takeout loan provides permanent loan financing over a longer term, such as 30 years. When I said Chinese, I meant Chinese food. I might be hungry. Obviously, large-scale disintermediation can reduce the mortgage money supply and cause interest rates to rise. Money in the marketplace. Money is bought. I love this. I think this is the best part of the whole course for me. Money is bought and sold in the marketplace like any other commodity. The interest paid on borrowed money is the price of money and can be thought of as rent paid for its use. Any commodity in short supply is expected to have a higher price and a lower price when the commodity is plentiful. The same is true for the price of money. Interest rates move up or down based on the supply available and demand for its use. Obviously, large-scale disintermediation can reduce the mortgage money supply and cause interest rates to rise. Disintermediation occurs when depositors bypass traditional depository institutions and invest directly into the stock market, mutual funds, artwork, and so on. Intermediation is the term used to describe the flow of deposits into lending institutions, creating a mortgage money supply. Discount rate. Federal Reserve member banks can borrow money from one of the 12 Federal Reserve District banks. The rate of interest that is charged by the Federal Reserve to a member bank on funds loaned is called the discount rate. I'm going to repeat that one more time. The rate of interest that is charged by the Federal Reserve to a member bank on funds loaned is called the discount rate. It's sort of like the opposite because it's not a discount, it's a payment, whatever. Mortgage bankers are the largest originators of FH and VA loans, but make conventional and commercial loans as well. Mortgage loan originators do not make loans. They arrange loans. Life insurance companies are the largest source of funds for financing both apartment projects and commercial properties. Life insurance companies are largest source of funds for financing both apartment projects and commercial properties. Interesting, life insurance. Although commercial banks make some long-term real estate loans, the largest impact of commercial banks in the real estate market is the making of short-term construction loans. Although commercial banks make some long-term real estate loans, the largest impact of commercial banks in the real estate market is the making of short-term construction loans. Their funds come from demand deposits in checking accounts and time deposits in saving accounts. A secondary mortgage market has developed to provide a constant source of funds with which to make real estate loans. This market consists of secondary market lenders who purchase mortgages originated in the primary mortgage market. Mortgages originated by primary lenders are bundled or packaged and sold to another lender in what is termed as a secondary market transaction. The principal secondary lenders are governmental or quasi-governmental agencies and include the following organizations. The Federal National Mortgage Association, FNMA. The Government National Mortgage Association, which is the GNMA. The Federal Home Loan Mortgage Corporation, which is the FHLMC. The Federal Home Loan Mortgage Corporation is nicknamed Freddie Mac. The Government National Mortgage Association is nicknamed Ginnie Mae. And the Federal National Mortgage Association is nicknamed Fannie Mae. And there we have it for Chapter 13. You can do it. You can do it.